Hey everybody, I'm going to walk you through the Chapter 3 Financial Statement, Cash Flow, and Taxes Excel assignment because I know that not everybody feels like they're experts at Excel. I promise you, if you take the effort to learn it, it'll be well worth it to you. And so hopefully, as I walk through this, it will be worth it. It'll be worth your time to follow along. I'm going to use the exact numbers that are in the assignment. So this is the same Excel spreadsheet that you would download. Um, and so really, if you follow along with me, you'll get 100% on the assignment. And then just so you know, the part that's in Cengage is just where you're going to be entering your answers that you get from this Excel spreadsheet. So all we're doing here is doing the work, and then you'll be entering the answers in on Cengage. Okay, so what we have here is what's called a comparative balance sheet. So it shows a balance sheet for a business comparing 2 years back to back. And a balance sheet summarizes the business's assets, that's the stuff it owns, and its liabilities, that's the debts it owes people, and its equity, which is the portion of the business that belongs to the owners of the business. So you'll see that the assets equal the liabilities and equity. And this is always the case. It's called the fundamental accounting rule. So assets always have to equal liabilities plus equity. In essence, what the business has either had to be funded through debt, borrowing, which would be liabilities, or through equity, through the owners contributing that money, or through the business earning it, which still belongs to the owners. And then they give us some additional information and ask us to construct an income statement. An income statement summarizes the revenue, that's the money we bring in from selling stuff to people, and the expenses, the money we have to pay out to run the business. So I'm going to do this using all Excel functions. So instead of retyping stuff, I'm just going to put the function in, and I'll show you what I mean by that. So the first line here of our income statement is sales. So rather than coming up here to where it says sales and like getting that number and then typing it in here, I'm just going to say equals. Whenever I hit equals on Excel, that means get ready for a formula or something. The computer kind of says, okay, they're going to do a formula. But you can also just do equals and then click on another cell and it will carry that amount down. So that's faster, I think, than typing it, and it reduces the chance of errors. All right, so now operating costs, excluding depreciation and amortization. It doesn't give us this information, but I do know that sales minus operating costs equals our EBITDA, or our earnings before interest, taxes, depreciation, and amortization. Okay, so it tells us that our EBITDA is 15% of our sales. So I'm just going to come here and I'm going to say this equals our sales and then times, and with Excel, the little asterisk or star is how we do times, that amount, 15%. And that will give me my EBITDA. And so now, since I know sales minus operating costs equals EBITDA, I can just say this equals the sales minus the EBITDA. So that's our operating costs excluding depreciation and amortization. All right. LC44 is our depreciation amortization. It looks like we have depreciation is 17% of our fixed assets. So if we come up here to the balance sheet, we can find total fixed assets, or they call it net fixed assets. So I can say depreciation equals the amount that is the net fixed assets times this rate here. And that gives me my depreciation and amortization. So my earnings before interest, taxes, depreciation, and amortization minus the depreciation and amortization is going to give me my earnings before interest and taxes, or EBIT. So I'm just going to say this cell equals the EBITDA minus the depreciation and amortization. Interest expense, it just gives us up here. So I'm just going to say this equals and click on cell C35, which is my interest expense. My EBIT, which is earnings before interest and taxes, minus interest will give me just my earnings before taxes. So this is going to be the EBIT minus the interest. Then our taxes are 25%. So that's 25% of our EBT. So I'm going to say this equals EBT times, I'm going to click here on cell C34, which is our tax rate. And our earnings before taxes minus our taxes will give us our net income. There we go. So we have actually completed the income statement, which wasn't so bad once you kind of know what you're looking for. And that's how a lot of this stuff is. Okay, and then our common dividends. This tells us our dividend payout ratio is 46.25%. Oh, and just so you know, I think I told you they would all be the same. I lied. So I forgot that the way this program is set up is it will give you new numbers each time. And so, the functions or formulas will be the same, but your numbers will differ from mine. All right. So to find my dividends, I'm just going to say they equal my net income times my dividend payout ratio. And then my addition to retained earnings is going to be any of that. So dividends just mean the share of the profit, or net income is another word for profit, but the share of that net income that we pay out to the owners. So it's kind of like their compensation for being owners of the business. And so any amount of that net income that we don't pay out as dividends will be added to the business's retained earnings, which just means earnings or profit the business made that it didn't pay out. So it's retained or held in the business. So that's just going to be the net income minus the dividends. And there we go. So there is part A. So in part B, we're going to construct a statement of stockholders' equity. So we're going to start with our balances at the beginning of the year or at the end of last year. So we can come up here and we can say, this is the end of last year. Okay, the column that's labeled 2020. So our common stock is 93,000. Again, instead of typing it out, I'm going to say equals, and then I'll go up to 93,000, which is D21, and hit enter. Common stock issue. Well, we don't know, but we do know our common stock at the end of the year. So I'm going to go up here, or at the end of this year, and say, I'm going to say that this equals, and then I'm going to go to the 2021 common stock amount, which is column C or cell C21. And now I can see if I had $93,000 worth of common stock issued at the beginning of the year, and I have 103,000 at the end, I know that the difference, 103 minus 93, is the amount of stock we issued, or $10,000 worth of stock issued during the year. Okay, retained earnings. I'm going to do the same thing. I'm going to hit equals. I'm going to go up to 2020 and choose the amount of retained earnings. That would be my beginning retained earnings. And then our net income for 2021, we just calculated right here. Remember on our income statement, I'll say equals and then go click on my net income. And then my cash dividends, that's the amount we paid out in dividends. I'm going to say equal. And I'm going to click on these dividends. Although here we've shown them as a positive amount, but for our statement of retained earnings, or I'm sorry, our statement of stockholders' equity, I'm going to show them as a negative. So I'm just going to put a negative in front of that C51. Because dividends are being paid out to the owners, they reduce the retained earnings of the business. So this addition to retained earnings is just going to be a net income plus the retained earnings. And we'll see that that will actually come out to the same thing we did up here for addition to retained earnings. All right. So our balance at the beginning is just going to be common stock plus the retained earnings. This will equal the amount of common stock that was issued. This equals the difference between our net income and our cash dividends. And then the total change to retained earnings is the retained earnings at the beginning plus. For some reason they have auto sum grayed out, so we can't use it. So we'll just have to do plus and plus. And then the same thing here, our balances. We just add these all up. All right, so the business had 103,000 at the beginning of the year in common stock. I'm sorry, 93,000 at the beginning and 103,000 at the end. Retained earnings have had 35,159 and 54,291 at the end. And we could double check these on our balance sheet. This just shows how we got the numbers, but our balance sheet shows us that our retained earnings went from 35,159, so it went up to 54,291. So those match. Okay, now we have our statement of cash flows. So sometimes when we earn income, it doesn't mean we get it all in cash. And so, and sometimes when we pay expenses to people, it doesn't necessarily mean we pay those expenses in cash. We can trade our services for other things besides cash. We can promise to pay people later, or we can do work for people and accept their promise to pay later. So here's how we do a statement of cash flows. It's pretty confusing the first time you do it, so don't worry too much about fully understanding why everything is. First, learn the process, which is what I'll show you. And then in time, if you have to, you'll learn the whys, okay? So we'll start with our net income. Again, I'll just hit equals and go up to our income statement and click on the cell with our net income, which is C49. And then we're going to add into our depreciation and amortization. So I'm going to hit equals. I'm going to scroll up to my income statement and click on the cell, which is C44, that has my depreciation and amortization. The reason I'm adding this is it is an expense, so it reduced my net income, but it's not a cash expense. We're not actually paying any cash for depreciation. So we add it back in. All right, now we're going to make adjustments based on our change in accounts payable and in accruals and so forth. And this is a little bit confusing, but here's what we need to know. When we make an adjustment for a liability, then the adjustment will go in the same direction. And I'll show you what that means in a minute. And when we make an adjustment for an asset, the adjustment will go in the opposite direction. So now let me show you what I mean by that. So accounts payable is a liability or a debt we owe to someone. So we're looking for the increase in accounts payable. So I'm going to come up to my balance sheet. I'm going to find accounts payable, and I'm going to take this year's accounts payable minus last year's accounts payable. That gives me the difference between the 2 years. So our accounts payable went up by $7,531. So we're going to also do a positive or an up adjustment to our cash, because accounts payable is debts we owe to people. And so if my accounts payable went up, then the assumption is I had expenses that I haven't yet paid. Okay. So my expenses from my net income aren't showing. They make it look like I paid all of that money, but I actually still haven't paid $7,531 worth. So I have that much more cash than my net income would show. Again, if that's too confusing right now, don't worry too much. Just know that because I was adjusting a liability account, I adjusted in the same direction. So the liability went up, so I adjusted cash up. Increase in accruals, same thing. I'm going to scroll up to my balance sheet. I'll find accruals under the liabilities and do this year minus last year. So same thing, my accruals increase, so I'm adjusting my cash up. So now I have my accounts receivable and inventories. These are both assets. So for these, I'm going to say equals, and then I'm going to put a minus sign because I'm going to do these the opposite. So if my assets go up, I'm going to decrease my cash. And if my assets go down, I'm going to increase my cash. And I'll explain why in a minute. But so we'll go up to it. So I put a minus and a parenthesis, and then I go up to accounts receivable. And I click this year's minus last year's. And then I close the parenthesis. So I'm telling Excel, do a negative of whatever we come up with here. So our accounts receivable went up by $19,467. So we're adjusting cash down by $19,467. The reason is our sales revenue makes it look like we made all of that money in cash. But if our accounts receivable went up, we haven't collected all of it yet. So we have $19,467 less cash than our net income would lead us to believe. Okay, again, if that's too confusing, just remember for assets, we adjust in the opposite direction. So if an asset increases, we do a decrease adjustment to cash. And conversely, if an asset decreases, we're going to do an increase adjustment to cash. So we'll do the same thing for our increase in inventories. Whoops. So I go minus, and then I go up my inventories and then my balance sheet and take this year minus last year. All right. And now if I add all these up, that will tell me my increase or decrease in cash. Okay. And again, normally I would use this sum button right here, but they have it grayed out for this exercise for some reason. So I'm just going to click each cell, net income plus, 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 plus. And that tells us that our business brought in $40,356 due to operating activities. And all operating activities means is the normal course of our business, the buying of stuff from our suppliers and selling stuff to our customers. So we have $40,000 more cash than we had last year because of our operating activities. All right, we'll move down to our investing activities section. This would be any additions to property, plant, and equipment. That property, plant, and equipment just means buildings, land, or equipment, stuff that we, big long-term assets like that we need to run our business. So we have to look at a couple things. So we're going to look at, go up to our balance sheet. We will see that there is a difference. If we look at this term right here, fixed assets is another term for long-term assets, which includes property, plant, and equipment. Okay, so we'll see that property, plant, or fixed assets went up from 43,601 to 69,361. So there was an increase to our property, plant, and equipment of that amount, about 25,000 something. Okay, but that's not all. So we also have to account for the fact that we had a depreciation in here because this says our net fixed assets, which is our assets minus any depreciation. Okay, so we know that our assets went up by that amount, but that we also had depreciation of, where's our depreciation? Oh yeah, we had it on our income statement. So our net change, okay, is going to be, or the amount we would have purchased would be this amount. So sorry, this year's minus last year's, plus we're going to add in that depreciation expense. Let's see, hopefully I didn't just make a mistake. I'm getting confused by all this now. I'm going to say this equals, and remember, since property, plant, and equipment are assets, the same thing, we're going to do a negative. So it's when we increase our property, plant, and equipment, we are actually decreasing cash. We're paying money for that. Okay, so I'm going to take where is it at? Net fixed assets from last year minus the net fixed assets of this year. And then I don't know what I just said to you. So I'm sorry if I'm confusing you a little bit with this one. And then minus our appreciation. So there's the amount of money we spent on investing activities. So the net cash used in investing is just going to be the exact same as, because that was the only investing activity we had. And finally, our financing activities, we're going to have our increase in notes payable. So again, this is a liability. So I'm going to hit equals, come up to my balance sheet, look at my notes payable, take this year's minus last year's. That will give me my increase. My increase in long-term debt, hit equals, come up to my balance sheet, click long-term debt this year minus last year's. My increase in common stock. So common stock means money put into the business by the owners. So I'm going to hit equals. I'm going to come up to my incomes or to my balance sheet, do common stock this year minus last year. And then our payment of common dividends, which I'm going to hit equals. I'm going to come up here to my statement of stockholders' equity and just click on my cash dividends. And then this is my net cash provided by financing activities. I'm just going to add all those up. So we actually brought in positive cash through financing, which would be either taking on debt or selling stock in the business, and then minus any dividends we pay out. So our net increase or decrease of cash now should equal the cash from operating activities plus the cash from investing activities plus the cash from financing activities. Then my cash at the beginning of the year, I go up to my balance sheet and look at last year's cash. That was my cash at the beginning of the year. And then I should be able to add these. So my increase to cash plus my cash at the beginning of the year. And if I scroll up to my balance sheet, that should match my cash at the end of this year, which it does. So that's a good sign that I did it right, even though I got a little confused there for a moment. All right. So now we have these ones that are a little bit more, I don't know, I'll say like we just don't use these as much all the time. Depends on your job. Some people use these all the time, but like I don't. So our net operating working capital and our free cash flow. All right. So our net operating working capital. So typically our working capital is just our current assets minus our current liabilities. So if we look up here at the balance sheet, we would just take total current assets minus total current liabilities. But operating working capital is a little bit different. It's just going to be our operating assets, which will be our cash, accounts receivable, and inventory. So our total current assets minus our accounts payable and accruals. So we don't include notes payable. Okay. So for this one, all we really do is say for 2020, we say this equals our total current assets minus our accounts payable minus our accruals. And that's it. For 2021, we'd say this equals our total current assets for 2021 minus our accounts payable minus our accruals. So there is our net operating working capital for 2020 and 2021. So I pulled this out of the book, what I'm just putting up on the screen here, which is the formula for free cash flow. You can see it's kind of complicated. It's the EBIT, which is the earnings before interest and taxes, times 1 minus the tax rate, plus our depreciation and amortization, minus our capital expenditures, which is that money that we paid out to invest in property, plant, and equipment. Okay. Plus the change in net operating working capital, which is what we just figured out here. So it's pretty complicated, but I'll go ahead and show you how to do it. And again, that's in the book if you need it. So I'm going to come here, whoops, to free cash flow and say this equals, and I'm going to put a parenthesis. I'm going to actually put two parentheses. And then I'm going to scroll up and click on my EBIT, which I figured out right here in my income statement. And I'm going to put times, put another parenthesis, 1 minus, and then I'm going to go up and click on my tax rate. And I'll close that parenthesis and close that parenthesis. And I'll hit plus my depreciation and amortization, which again, I'll scroll up and click on my depreciation and amortization from my income statement. And I'll close that. So there's my first part of that. And then I'm going to say minus, and I'll do a parenthesis, and I'll click on capital expenditures, which is actually this net cash used for investing activities. We actually want this as a positive number though. Okay, so that's going to confuse things. So I'm going to say the absolute value of C80, which is the amount of money we paid, but it wants the positive value. I know it's confusing, for purchasing that property, plant, and equipment. Plus, I'll put another open parenthesis, and that's going to be the 2021 net operating working capital minus the 2020 net operating working capital. I'll close that parenthesis and close that parenthesis, and that's my whole formula. That's pretty crazy. I'll leave it there, or you can pause the video so you can see it. So I can see that my free cash flow is negative 778.61. That actually means that I'm not going to have enough cash flow to cover things. So I'm going to have to do something about it, which is a good thing to know ahead of time, right, for a business. Well, that we didn't have enough in this past 2 years, and so we need to adjust. Okay. All right. So let's take a look at EVA. So EVA is our earnings before interest and tax times 1 minus T. So the same thing we started up with here. Okay. Minus our total invested capital times the cost of our invested capital. So I'll say equals, I'll put a parenthesis, I'll go up and click on my EBIT, which I have all the way up here in my income statement, D47, times 1 minus my tax rate. So there's my first part. And then minus my total invested capital. So total invested capital is the money that we've put into the business, which is really our total of I'm going to do an open parenthesis, our long-term debt plus our total common equity. Whoops. I needed to have two parentheses there. And then we're going to multiply that by our cost of capital, which is given to us right here. So what this means is that we're actually making more money than it's costing us, which is a good sign. Okay. So finally, I know this is tough. And I promise you, this is stuff that you won't have to memorize very much of this. Like in real life, we don't use a lot of this unless we do very specific jobs. But learning how to use the Excel will be a benefit to you. So our MVA, our market value added, um, is the difference between the market value of our equity and the book value of our equity. Okay. So this tells us the stock price is $21 and there's 10,000 shares outstanding. So the market value of our equity is just the stock price times the number of shares. And then we subtract our, if I can find it, there's so much stuff on here. There it is. We subtract from our balance sheet our total common equity. So in essence, we're saying the market value of our stock is 21 shares times 10,000, or $21 a share times 10,000 shares. The book value of our equity is just our stockholders' equity, our common stockholders' equity right there. And so that's it. So again, our market value equity is worth 52,709 more than our book value. And I shouldn't mention that I think everything we're doing on this is in thousands of dollars, which means we add zeros. So instead of 52,709, this actually represents 52,709,000. But they do that where they'll put in thousands to just make life easier. Drop those zeros off. We don't need them. So I know that was kind of long. I hope you learned more or became more comfortable with Excel and learned something about these different statements and how they're formed. If you don't feel like an expert, don't worry. Just keep plugging and this will all get easier and easier. I hope you have a great week and good luck on the rest of the week.